Welcome to the Investing Show, where we discuss ideas to help you make more of your money. I'm Simon Lambert of This Is Money. Joining me in the studio today, delighted to welcome Gary Greenberg, Hermes Head of Emerging Markets, and Richard Hunter of Interactive Investor.
Hello, Simon.
Gary, emerging markets had a good year last year, but the run dates back further than that, doesn't it? What's been going on and what's been driving it?
Emerging markets had a 4-year bear market from 2012 through 2015, and then started to recover with the commodity prices, which got really cheap. The idea was that commodity cycle was never going to come back. Emerging markets were just not interesting. In 2016, commodity prices jumped, and people started to realize that China actually wasn't going to go into a tailspin. And with renewed confidence in the Chinese economy, investors started to dip their toes in the water in 2016. In 2017, momentum helped, but there was just increasing amounts of confidence that the outlook for emerging markets was decent, and so investors started to invest. They're continuing, and the moves have continued into 2018.
So I was looking at the details of the fund that you managed, the Emerging Markets Fund at Hermes, and over 1 year the performance was up about 35%. The sector was up about 24-25%. Over 5 years, the fund's doubled the performance, almost 100%, and the sector's up more like sort of 45 to 50. Now, if we go back in time, I suppose we could have said that emerging markets was a value opportunity because they look cheap. But with that kind of performance behind it now, can they still be termed a value opportunity? Do they still look cheap, or are we having to look at other things?
Well, emerging markets were cheap pretty much across the board back in 2016. The price to book ratio was really 1.5 standard deviations cheap relative to the average. Now it's average. PE ratios were cheap back then. Now they're slightly above average. So by themselves, they're not a screaming value. They're reasonably valued. In a world where most of the developed markets look pretty overvalued, and bonds certainly look overvalued, emerging markets represent a reasonable investment. You're not getting in at the bottom, but we think right now it still looks like a reasonable place to be.
We often ask the question of emerging markets because it's got to be fluid by definition. When will China stop being an emerging market, and at that point, what sort of impact might that have on you?
Well, when China does stop being an emerging market, if they're lucky enough and skillful enough to get there, the removal of China from the emerging markets benchmark would be a huge change in terms of emerging market investing. Right now, it represents a tremendous opportunity, both in terms of its GDP growth rate, but also in terms of growing intellectual property, patent applications, higher education, innovative companies, deep, rich market. So right now, it's a great place to look for stocks. When will China get there? It could get there towards the latter part of the next decade. If GDP per capita heads towards, $18,000, $20,000, it could be recategorized as a developed market. We have a long way to go before we get there, but it's possible.
And a lot of your fund is invested in Asia.
Yeah.
Do you think that's where the best opportunities lie? Or is it just that Asia dominates emerging markets so much?
Emerging markets have a cyclical aspect and a secular aspect. In terms of the cyclical aspect, we've got coordinated global growth right now, which is good for commodity stocks and commodity countries. We find most of those in Latin America and the EMEA region, Russia, South Africa, Brazil, Peru, Chile, etc. So from a cyclical standpoint, and this would be shorter term because the cycle's gone on a while now, there are pretty good momentum opportunities in those markets. From a secular standpoint, however, Asia represents an area in which Korea, Taiwan, China, which is 50% of the benchmark, you have a lot of companies with intellectual property, their own intellectual property, with innovation, who are able to serve the cutting edge of technology, actually. maybe they're not at Google's level, but companies like Alibaba, Tencent, Advantech in Taiwan, et cetera, all these companies are innovative and long-term players. So we think from a long-term perspective, you do have some really, really interesting ideas coming out of Asia.
And then these are the companies that could deliver over the next 10, 20 years, do you think?
We think that's possible, yeah. We think that's entirely possible. Obviously, things can get undervalued and overvalued, and some of the exciting names are getting well valued at this point. So one has to look around and make sure that one isn't overpaying for the excitement. But we do think that there are a number of companies across the world in emerging markets. This is what people, I think, don't quite realize. It's not so much the cyclical ups and downs of emerging markets, but you have managements who have been in place for 20, 30, 40, 50 years. Okay, they change when they get old, but that know how to operate in their countries, and in many cases can add value over decades. And we think that those opportunities are the ones that investors should be looking for in a fund, or if they're intrepid enough, on their own.
From a practical point of view, for the UK investor, is it fair to say there's certain emerging markets that you can't access as an individual? So there's a bit of a double whammy through using a fund. Number one, obviously you're benefiting from the expertise.
Yeah.
Number two, it might be one of the few ways you can actually get into that market.
That is true. That is true. There are any number of markets where it's not easy to go. And then once you're there, knowing really what's happening, having long conversations with management, doing extensive spreadsheet analysis, etc., that's not something that the average UK investor can do.
Sure.
You've been investing in emerging markets quite some time now, I understand. What was it that attracted you to them, and how long does your investment in the emerging markets field go back?
So it goes back to the late 80s, and I was attracted to them simply because there's an analogy, there's a metaphor of the zebra and the herd. And zebras have a dilemma. They can either eat the grass where all of the herd is, which is much shorter and not so tasty, or they can eat at the very edges of the herd, but they risk being eaten by lions. So depending on your risk appetite as a zebra, you'll choose one or the other. And I've always had more risk appetite, so I've been interested in the juicier grass, so to speak. Once in a while, I get the scare of a lion coming around or a global crisis. But emerging markets are less well analyzed, much more emotional. There's a lot of inefficiencies in emerging market companies. And so that's the area I've always found the most interesting.
And how has investing in emerging markets changed over that time? I imagine the amount of information you can access is possibly one of the major changes.
Yes, that is a big change. Now there is a lot of information available, even down to companies with market caps of £500 million or less. There is good information. Managements are more forthcoming because they understand most of them understand they have a duty to explain to shareholders, outside shareholders. The China A-share companies haven't really figured that out yet, but most of them have. Also what's happened is there's been a real change in the composition of the benchmark. We've gone from cyclical countries dominating, Brazil, Mexico, South Africa, Turkey, Russia, to much less cyclical countries such as Korea, Taiwan, and China, representing a large part of the benchmark. That means that the old ways of looking at the cycle in terms of U.S. interest rates, the dollar, commodity prices, are much less important now. What's more important is domestic policy and the ability of the individual company to add value. So we think that that's really the key. Can you find companies which can add value, beat their cost of capital, and grow their businesses in such a way as to give you, a hard currency investor, a consistent return?
So presumably somewhere within your portfolio, you're going to have the kind of stocks that are going to benefit from the change, for example, in China and to some extent India, between ruralisation and urbanisation and the emergence of the middle class, so things such as service companies, maybe insurance companies and so on.
Absolutely. Financial services represent a way to play the consumer in emerging markets, and we have quite a few of those. We're a little bit overweight there. We also have companies that can find access to the consumer directly through technology, such as Tencent, for example. Also, increasingly, we're finding emerging market multinationals, companies that are based in emerging markets but have businesses all over the world, whether they're part of a supply chain or whether they've got their own individual niche. Samsung is one, for example, but also companies who help create smart cities, smart factories, etc. These kind of businesses are very interesting because they're part of the global economy. You have to be very competitive to get that niche, but some of them do.
Do those companies, almost by their nature, in terms of if they want to crack it in the developed markets, if they want to come in and upset the apple cart, you know, try and take business from an incumbent that might have been operating there for a long time, or try and do something new, do they, almost by the time they start doing good business in a developed country, do they have to be disruptive in their very nature in order to actually get that foothold in there and knock that incumbent, you know, developed market company out of the way?
It's a gradual process. Usually what they've done is they've become very, very competitive in their home country market. So they have good revenues, good cash flows, good business. And then if they're competitive enough to be able to get the first order in the developed economy, then they can begin to build on that. There's an interesting company called Bharat Forge, which is in India, which used to just make crankshafts for lorries, for trucks. And they got gradually better and better at it. What they did was they started hiring PhDs from the Indian Institutes of Engineering and Technology to work on material science, to work on making that crankshaft a little stronger, a little lighter, a little more efficient. Eventually, with this focus, this intense focus, they had a product which other people wanted. Now they have something like 40% of the North American Class 8 truck market. So if you've got enough focus, enough expertise, then you can begin to go overseas, and some of them have.
And on the other side of what we were talking about a few minutes ago, in terms of the consumer, that sort of very much seems to be a big story in the Asian emerging markets, the story of the Asian consumer. Now, I don't want to do down the US consumer or the British consumer or the European consumer, but they don't really look that healthy, do they? In general, how healthy does the sort of Asian consumer market look in comparison to that in the West?
Well, there are various ways to look at it. Demographics is one. And in demographic terms, Northern Asia isn't all that exciting. They are aging pretty quickly. South Asia is very attractive demographically. In terms of debt levels, generally speaking, the Asian consumer is in pretty good shape. Korea may be a little higher. China is still growing, but not very high. So you do have a lot of purchasing power potential. And as mentioned earlier, urbanization is still a trend in many of these countries. Financialization is still very low, financial penetration very low, so there is a long way to go. Consumption levels are much lower than in the West, and so therefore there is potential. The countries are growing, you know, anywhere from 2 or 3% at the low end to 6 or 7 or 8, and that obviously is good for the consumer.
So is it within your portfolios, would it tend to be more of a growth story which will categorise your funds as opposed to income? I mean, even in the US, for example, dividend yields tend to be significantly lower than in the UK. And obviously in the historically low interest rate environment we find ourselves, there is this hunt for yield. Or are you pretty much looking for growth in those emerging markets?
Yeah, we're looking for sustainable growth. Sustainable. We don't need companies to be growing at 30, 40, 50%. I mean, once in a while, usually those get overvalued pretty quickly. We're interested in companies growing at between 10 and 25%, but that can sustain a decent teens or low 20s level for a longer period of time. We're very interested in managements that A, have expertise, know what they're doing, but B, are responsible to shareholders, to their employees, to the environment around them. In that way, one can count on the company being able to continue to add value and wealth over a longer period of time. And that's what we're really keen on. I
only got time for one more question, I'm afraid, before I wrap it up. But I just wanted to ask a little bit about the countries that are maybe below the headline emerging markets, countries that we normally talk about. I don't know whether they fall within your remit, but how interested are you in the places like perhaps Vietnam, Cambodia, or maybe some of the Eastern European, the European emerging countries as well? Or even, going into Africa as well. Obviously, you're sort of treading on the toes of the frontier markets there, but...
We have invested in Egypt, we've invested in Nigeria in the past. We've invested in a Hong Kong-listed stock with operations in Cambodia. For the most part, these markets, especially the sub-Saharan markets, are very, very illiquid. They tend to be the remit more of emerging market debt players who can buy the sovereign, and the sovereign will have a high yield with fairly high risk. Also, we find that the corporate governance in a lot of these off-the-radar emerging markets is questionable. And we're not really that willing to take our investors' money and put it with a management that we don't trust. We have a pretty focused team, 5 analysts who cover about 10 stocks each, so they get to know them very well. And if we feel like there's an issue with the governance, we're out. So we're looking at long-term sustainable value creation. And if it was available in these countries, we'd be very interested, especially if it was liquid. And we look, but we don't find it too often.
Okay. That's all we've got time for. Gary, thank you very much. Richard, thank you very much.
Pleasure.
And thank you very much for watching. Join us next time on The Investing Show. Goodbye.